Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by subscribing to our channel and drop any comments below. Okay, let's get started.
It is February 9th, 2026. And we are looking at a financial paradox that I honestly believe is going to be studied in business schools for decades. On one side of the ledger, you have Oracle Corporation. They've just reported a backlog, remaining performance obligations, or RPO, of $523 billion. That is $500 billion of contracted future revenue. It's a number that frankly has no precedent in software history.
And yet, if you open up your trading terminal right now, the screen is it's deep red.
Exactly.
The stock has collapsed 58% since the highs in September 2025. The market has just erased $463 billion in value in under 6 months. So the question we're debating today is singular, and the stakes, well, they couldn't be higher. Is this a fundamental collapse of a legacy tech giant, or is this the buying opportunity of the decade? We are testing a very specific thesis here. Can Oracle successfully pull off this transition from a legacy database vendor to the primary architect of AI infrastructure and hit a $2 trillion valuation by 2036? Or will the sheer capital intensity of this build-out, this liquidity crisis staring us in the face right now, bankrupt the whole strategy before it even gets off the ground?
Frankly, I think strategy is a very generous word for what we're seeing. You look at that $523 billion backlog, and you see a gold mine. I look at the balance sheet, I look at the desperate financing measures they just announced, and I look at their bond yields. I see a company mortgaging its entire future to chase a low-margin hardware business. This isn't just a market correction. It's not just noise. It's an existential gamble that, right now, is failing.
I understand the fear. I do. It's visceral. But I believe the market is pricing Oracle as a distressed software company, when the data, the actual data, proves it's already evolved into something else entirely, a Zetascale AI foundry. That 58% drop is a panic reaction to a short-term liquidity squeeze. But if you look at the growth engine, specifically that 68% growth in Oracle Cloud Infrastructure, or OCI, the math supports a 5x return over the next 10 years.
See, I just don't buy that the liquidity fears are short-term. That is the fundamental disconnect here. I'm arguing the funding squeeze is structural. When major U.S. banks retreat from lending you money for data centers because the risk profile is too high, and you're forced to dilute your own shareholders with a $20 billion equity issuance just to buy GPUs, well, that changes the investment thesis entirely. You aren't investing in a software compounder anymore. You are investing in a capital-heavy utility company with an identity crisis.
Let's pause there and really lay out the positions properly, because I want to isolate this bull case before we dissect the financing. You have to understand the cloud infrastructure inflection. If you just glance at the headline revenue growth for fiscal 25, it looks boring. 8%, moderate. The market just yawns.
It's stagnant. For a tech company in an AI boom, 8% is a rounding error.
Only if you look at the top line. But you have to look under the hood. The internal revenue mix has rotated, violently, toward the future. In the second quarter of 2026, OCI, the cloud infrastructure segment, grew 68%. We are talking about $4.1 billion in quarterly revenue for that segment alone. This is not a pilot project anymore. This is a massive, hyperscale business growing at startup speeds.
It's impressive growth. Sure, I'll grant you that. But it's still a minority of the total revenue pie. They are still, by and large, a database support company. That is what pays the bills.
For now, but markets are forward-looking mechanisms, or at least they're supposed to be. The leading indicator here is that RPO number, up 438% year over year. That $523 billion backlog isn't vaporware or some optimistic projection from a sales deck. This is driven largely by that massive $300 billion OpenAI Stargate partnership. This is contracted demand. So Oracle is no longer a legacy company protecting a declining asset. They are building the actual factories for the AI age. When you have that kind of visibility, $500 billion locked in, Selling the stock down 58% looks less like a warning sign and more like a massive pricing error.
See, I come at this from the complete opposite direction. You say contracted demand, I say unfunded liability. The reason the market wiped out nearly $500 billion in value isn't because traders can't read an RPO report. It's because they understand the cost of capital. The reality check here is financial sustainability. We know for a fact that U.S. banks stopped lending for these specific data center projects. Why? Because the risk profile is too high.
Well, banks are conservative by nature. They often miss these inflection points.
Or they read the balance sheet better than we do. So what did Oracle do in February 2026? They announced a $50 billion financing plan. And the ugliest part of that is the $20 billion at-the-market or ATM equity issuance. For anyone listening who doesn't follow capital markets, let's be crystal clear about what an ATM issuance is. It means they are printing new stock and just selling it directly into the market to pay bills. They are diluting you, the shareholder, to buy hardware. Borrowing costs for Oracle have doubled since September. They're trading near non-investment grade levels in the bond market. You're talking about a company that is essentially taking out a second mortgage at predatory rates to build capacity. And that capacity carries much, much lower margins than the software business that made them famous.
I think predatory is a bit hyperbolic, but let's dig into that margin argument first. That's really the core of the skepticism, isn't it? You're worried that by pivoting to infrastructure, they're trading high-quality revenue for low-quality revenue.
Exactly. Let's just look at the unit economics. Traditional software support, the Oracle of old, had 80% gross margins. You sell a license once, you collect maintenance fees forever. It is the best business model ever invented. It prints cash with zero incremental cost. Now look at AI infrastructure. You are lucky to get 30 to 40% margins. You have massive depreciation on the chips. You have enormous energy cost. You have hardware failure. Even if revenue grows to the sky, the profitability per dollar is shrinking. You're turning a software compounder into a capital-heavy utility company, like a power plant. Can you really maintain a high-tech valuation multiple when your unit economics look more like Duke Energy than Microsoft?
That is the consensus view, and it's logical on the surface. But I would frame it differently. You're assuming that the AI build-out cannibalizes the high-margin database business. I argue it protects it. This is the whole cloud neutrality and multi-cloud argument. Look at the numbers for Q2 2026. Multi-cloud database consumption grew 817%. That is an astronomical number.
But explain what that actually means. How does that protect the margin?
What Oracle has done is strategically brilliant. They realized they weren't going to beat AWS on general compute for everyone. They were too late to that party. So they decided to be the Switzerland of the cloud. They put Oracle database hardware inside Azure, inside AWS, and inside Google Cloud. They have 45 regions live now. This means a customer can use AWS for their front end, but the heavy database lifting is happening on Oracle Metal, sitting right there in the same data center.
But isn't that just admitting defeat? Admitting they can't be the primary cloud?
No, it's securing the moat. This strategy keeps that high-margin database IP sticky. Customers don't churn to Amazon Aurora or Google Spanner because they can run their mission-critical Oracle database natively on AWS infrastructure. So you keep the 80% margin database revenue, that cash cow stays safe, and you layer on the massive, albeit lower margin, AI infrastructure growth on top. It's not a trade-off, it's an additive layer. You use the infrastructure to lock in the software.
It's a nice narrative, but let's look at the cost of that additive layer. We have to go back to the liquidity and the dilution. You kind of waved off the $50 billion plan earlier, but let's be precise about what this signals. A $20 billion ATM program, that is massive dilution for current shareholders. You're cutting the pizza into significantly smaller slices.
It's dilution, yes, but it's necessary fuel.
It's not just the stock printing, though. Look at the cash pull-forward tactics they're using. They're demanding new customers pay 40% of the contract value up front. That is unheard of for a company this size. Microsoft doesn't do that. Amazon doesn't do that. When you're asking customers to prepay so you can afford the equipment to serve them, it's a Ponzi-like dynamic. And the rumors about divesting Cerner Oracle Health, a fire sale of an asset you bought for $28 billion just a few years ago, these are not the moves of a stable compounder. These are the moves of a company that is desperate for cash.
I'm not convinced by that because it ignores the context of the credit environment. The $50 billion raise, splitting it between equity and bonds, is a balanced approach. I mean, think about the alternative. If they tried to fund this whole build-out with debt, they would have blown out their leverage ratios, they would have lost their investment-grade credit rating. That would have been catastrophic. Taking the dilution pain via the ATM was actually the responsible move to save the balance sheet.
Responsible, or was it just the only option left?
It was the prudent option. And regarding the desperate measures, I see them as aggressive restructuring. Yes, the potential layoff of 20 to 30,000 employees is painful. That's 10 to 15% of the workforce. But in the context of a pivot of this magnitude, it is a necessary evolution. They're cutting legacy costs to free up $8 to $10 billion in annual cash flow. And where does that money go? It goes directly into GPU purchases. They are reallocating resources from the past to the future. That is what good management does. They don't cling to bloated cost structures out of nostalgia.
But at what operational cost? You cut 30,000 people, you break things. Institutional knowledge walks out the door, support quality drops, and you're doing this while trying to execute the most complex engineering feat in the company's history. Let's talk about those execution risks. This is topic 3 in our breakdown. The physical limits. The big tech AI bet, this $650 billion industry-wide spend, is hitting a wall, and that wall is power. You can sell $523 billion in contracts, but if you can't plug the servers in, that revenue is zero.
Power is the bottleneck. I agree with that.
It's more than a bottleneck. It's a hard stop. Oracle is relying on unproven nuclear microreactors and long-term power purchase agreements in a volatile market. We're seeing energy costs spike globally. That 30 to 40% margin target you're defending, that assumes stable energy prices. If power costs go up, those hardware margins collapse even further. They are building gigawatt-scale data centers. You can't just plug those into the local grid.
See, I actually view the power constraint as a feature, not a bug for Oracle, because they're solving it better than the hyperscalers.
How? They don't have a magic wand for physics?
No, but they have a better strategy for where they build. Oracle is winning because they are building what the others won't. They're building sovereign clouds.
Sovereign cloud sounds a bit like marketing fluff.
It's not. It's geopolitical reality. They're going to the UK, to Europe, to the Middle East and saying, we will build a complete cloud inside your borders, subject to your laws, disconnected from the US grid if necessary. AWS and Azure struggle with that level of customization because their architectures are monolithic. Oracle's is modular. They can drop a disconnected cloud region into a bunker in Saudi Arabia or a government facility in Germany. That is why they are winning these massive government contracts.
Okay, niche government contracts are one thing, but can they compete at scale?
And regarding that minnow comment I hear people make, that Oracle has maybe, 3% market share while AWS has 30%, that's a lagging indicator. You have to look at where the puck is going. OCI revenue is projected to hit $144 billion by 2030. That would surpass Google Cloud's current size. And look at the client list. They aren't just selling to startups. They signed a $20 billion deal with Meta. They're building for XAI. They're even building clusters for NVIDIA's own internal use. When the company making the chips chooses your cloud to do their R&D, that is the ultimate validation of your technical architecture.
That assumes they can deliver the Stargate project on time and on budget. We're talking about $156 billion in capital spending for that OpenAI deal alone. Construction delays, permitting delays, power delays, cost overruns, any of these just eat into that return. But let's look at the valuation. You teased a 5x return earlier, a $2 trillion market cap. Walk me through the math, because I struggle to get there, especially given the dilution we just talked about.
The math is actually pretty straightforward if you believe the 2030 targets. Management has set a target of $21 in earnings per share for fiscal year 2030. Now, historically, high-growth cloud stocks trade at a premium, but let's be conservative. Let's say they trade at 28.5 times earnings, which is roughly the NASDAQ 100 average right now. If you take $21 EPS and multiply it by 28.5, you get a stock price of roughly $600. From the February 2026 lows of around 143, that's a 4.2x return just to 2030.
Okay, hold on.
Let me just finish the projection. To get to the full $2 trillion, or about $715 a share by 2036, they only need to grow earnings by about 5.3% annually after 2030. That is a very low bar. Once the data centers are built, the capital expenditure, the CapEx, drops, and they enter what I call the harvest phase. The cash flow will be immense because the factories are built and running.
That is a perfect world spreadsheet. It assumes everything goes right. Here's my counter math. The PE multiple. You're assuming the market awards them a 28x multiple, a software multiple. But we just established, through your own admission, that they are becoming a hardware infrastructure company. Utilities do not trade at 28 times earnings. They trade at 15. If margin compression happens because of high energy costs, and the market decides Oracle is just a pipe for AI, that multiple compresses aggressively.
15 times is incredibly low for a tech leader.
Is it? $21 EPS times a 15x multiple is $315. That's a decent return from today's lows, sure, but it is nowhere near $2 trillion. And more importantly, that $315 target doesn't justify the risk of insolvency they are flirting with right now. And let's be honest, that $21 EPS target assumes no further dilution. What if they have to go back to the ATM window next year because the nuclear reactors cost double what they thought? That EPS number drops significantly.
I think predicting a 15x multiple for the primary enabler of artificial general intelligence is overly pessimistic. You're valuing them like a coal plant when they're building the engine of the global economy. But even in your downside scenario, you're admitting the stock doubles from here.
Doubling isn't enough if the risk of zero is non-zero. And that's what keeps me up at night regarding the stock, the leverage.
The key here really is that harvest phase. You're right that the build-out is capital-intensive right now. It hurts. But these assets have long lives. Once the concrete is poured and the fiber is lit, the incremental margin on that infrastructure goes up. And remember, they are locking customers in with the database. It is not a commodity pipe if your critical data is stuck inside it.
Stuck inside it is a harsh way to put it, but it's accurate. Vendor lock-in is powerful, but lock-in only works if the vendor stays solvent. I want to circle back to the Cerner divestiture dilemma one last time. If they sell Oracle Health Cerner, they are admitting a massive strategic failure. They spent $28 billion on that acquisition. If they sell it for pennies on the dollar just to fund GPUs, it destroys the narrative of the integrated data vision Larry Ellison had. It makes them look tactical, flighty, not strategic.
Or it makes them ruthless. And in this market, ruthless wins. If Cerner is losing market share to Epic, which it is, and the VA contract is difficult, which it is, then dumping it to fund the highest growth opportunity in history is actually good capital allocation. It shows they aren't falling for the sunk cost fallacy. They're clearing the decks for AI. Look, the risk is real. I'm not denying the volatility. But when you have a $523 billion backlog, the demand question is answered. The only question left is execution.
And financing. Demand without the cash to build the supply is just a wish list. I look at the 20 to 30,000 people losing their jobs, the 40% upfront payments demanded from customers, and the frantic share issuance, and I see a company stretching itself to the absolute breaking point.
It is a stretch, yes, but that is what creates the margin of safety for the investor. If everything were perfect, the stock would still be at its September highs. The 58% drop is the discount you get for taking on that execution risk. We are at a rare entry point. The chips are secured, 96,000 of them. The financing is painful, but it's resolved. The path to $2 trillion is mathematical and driven by an inevitable wave of AI adoption.
And I conclude that the risks are structural. This isn't just a cycle. Oracle is fundamentally changing its DNA. They are betting the entire company on a capital-intensive model that degrades their margin profile. They are relying on massive cuts and dilution just to survive the next 12 to 24 months. The Stargate is expensive, and if they stumble on execution, be it power, supply chain, or their credit rating, there is no safety net left.
It is definitely a high-stakes game, but that is where the returns are. Oracle has fundamentally changed from a value and buyback stock to an aggressive growth story.
On that, we agree. It's a different beast now.
The listener just has to decide if that risk-reward profile actually fits their portfolio.
Indeed, a fascinating moment in tech history.
Absolutely.
If you like this video and want to watch more content like this, then hit the subscribe button. It's totally free. Thanks for watching and see you in the next video.